SanDisk and Western Digital both beat, and the entire memory trade broke anyway, taking Seoul down with it. 4 more stories moving the AI tape today. Let's get into it. SanDisk and Western Digital both beat the quarter, and both guided above the street at the top end, and it was Seoul that paid for it. The Kospi fell 4.6%, SK Hynix down about 10% intraday, while Western Digital dropped 16%, and SanDisk 11% in New York. The problem was the bar. SanDisk came into the print up 469% year to date, Western Digital up 202%. At that setup, a guidance midpoint below consensus is a sell signal, not a beat. This is the first time the memory shortage narrative has broken on the company's own numbers rather than a macro shock, and it landed on the single most crowded AI long of 2026. The bear case is specific. Data center memory demand was never questioned. What broke was the assumption that consumer and PC weakness could be ignored while contract prices only went up. The next read is Micron's guide. If consumer softness shows up there too, this is a re-rate, not a shakeout. Atlassian spent a year as the market's favorite short expression of the idea that AI kills seat-based software. Then, cloud revenue growth accelerated to 31%, from a business that was guiding 23% as recently as February. And the stock ripped more than 30% after hours. Revenue landed at 1.77 billion pesos, up 28%, against consensus near 1.66 billion. Earnings came in at $1.87 versus $1.50 expected. Management credited AI adoption for driving seat expansion and higher net revenue retention, which is the exact inverse of the bear thesis. This is the first large-cap data point arguing AI is a tailwind for collaboration software rather than a substitution risk. The bear case, 1 quarter of reacceleration, does not disprove a multi-year substitution curve, and subscription ARR still grew a slower 23%. The forward signal is co-founder Mike Cannon-Brookes, who disclosed a plan to buy up to $250 million of stock into that gap. If those purchases actually execute after the cooling-off period, the reacceleration is being backed with founder capital. Alibaba is about to start billing the companies its free weights armed. Reuters reports the next Quen release will carry revenue-sharing terms. Large firms reselling the model as a service must sign a commercial agreement and hand over a cut of revenue, while researchers and small developers keep free access. The plan could arrive as early as next week. For 2 years, free Chinese open weights have been the price weapon aimed squarely at OpenAI and Anthropic. This is the moment that weapon starts collecting rent. It mirrors Moonshot's Kimi K3 license, which targets model-as-a-service providers above $20 million in annual revenue and reportedly charges up to a 30% share. The bear case, the percentage is not finalized, and any meaningful toll pushes serious deployments back toward the American labs, right as OpenAI cuts API prices by up to 80%. Watch the license text at release. If the revenue threshold lands low, every Western inference reseller built on free Quen reprices its gross margin overnight. OpenAI just priced its first hardware against Apple and Amazon, and it is not competing on cost. Bloomberg and The Information both put the Jony Ive device at $300 to $400, a hockey puck-sized, screen-free, battery-powered speaker with a camera, microphones, and moving parts meant to convey personality. That is 2 to 4 times what Amazon and Google charge for a smart speaker. OpenAI is not fighting for the smart home slot. It is trying to establish a premium ambient computing category before Apple or Amazon ships a credible LLM-native device, with the screen-free family targeted at 2027 out of the I/O acquisition. The bear case, a hardware bill of materials and a retail channel, are a fundamentally different cost structure than an API business, so expect gross margin drag well before revenue. And note the tension with the last story. OpenAI is spending to own the hardware surface, while Alibaba starts taxing the software layer underneath it. The signal to watch is any slip in that 2027 date. That slip is Apple's opening. A New Mexico judge now has a say in how Meta designs its apps. Judge Brian Beedscheid found Meta liable for creating a public nuisance and ordered $567 million into an abatement fund, on top of the $375 million imposed in March, bringing the total to $942 million. The money is the smaller half of the story. The order dictates how Facebook and Instagram must function for minors in the state for 5 years. Monthly usage limits for teens, notification restrictions, tighter controls on adult contact with minors, and safeguards on AI chatbots. That last provision is the first time a court has written companion AI rules into a social media remedy. Attorney General Raul Torres won this on a state consumer statute, routing around the federal legislative deadlock entirely, and roughly 40 other state AGs now have a proven playbook. The bear case for Meta: immaterial to cash, material to the compliance cost trajectory. The next read is the second state to file on the same nuisance theory. The through line today is repricing, story by story. Memory broke on its own guidance, SAS reaccelerated against its own bear case, and open weights just started sending invoices. Beating consensus is no longer enough, only the bar matters. Subscribe for tomorrow's briefing. This is the Daily Alpha.